This week we are learning about analyzing and recording transactions. You're familiar with the concept that financial accounting is based on financial transactions, right? We need to take those transactions. We need to go through this whole 9-step process in order to have financial statements and close out the accounting records. So we today are going to get into a little more detail on how that all works. Okay, and as I mentioned, you might want to take really good notes today because these are really important concepts. So we will spend some time talking about principles, assumptions, and concepts of accounting. These are basically the rules that require us to do financial accounting a certain way. You've heard of GAAP. Can somebody tell me what GAAP stands for? Perfect. Generally accepted accounting principles. Those principles include these assumptions and principles here. Okay, so we'll understand what those are. We know the accounting equation. We've already learned that. Who can tell me what is the formula for the accounting equation? That is for the income statement. Okay. I'm sorry, say a little bit louder.
Asset plus liabilities equals owner's equity.
So you're on the right track, Jacob, right?
Yeah.
Jake? Yeah. So, go ahead.
Assets equal liabilities plus.
Yeah. So you can say assets equals liabilities plus equity, or you could say assets minus liability equals equities, or assets minus equity liabilities. So you can. There are some ways you can switch that around, and all of those are called the accounting equation. Now we're going to get into an expanded accounting equation that goes into a little more detail. We will learn about the 9 steps in the accounting cycle. We will learn about how to see how any one transaction impacts the accounting equation. I told you that with our double entry bookkeeping system, every transaction impacts at least 2 accounts, right? And so those 2 accounts, they might both be assets, they might both be liabilities, they might both be equity accounts, or it could be a combination. So anytime there's a financial transaction, we can look at it and see what impact does it have on the accounting equation. And the accounting equation will still always balance out. Assets are always going to equal liabilities plus equity, but they do change over time. We'll learn about journal entries and T accounts. Some of you mentioned T accounts earlier. So we'll learn what those are. Those are basically steps 2 and 3 in the accounting cycle. And step 4 is preparing our first trial balance. So we'll learn how to do that as well. I think we've talked about some of these concepts a little bit last week, but I'm sure they haven't completely sunk in. So hopefully by the end of this week, you'll kind of see the big picture of how accounting works. And then as we go forward in future weeks, it's all going to refer back to what we learned here. Okay? Does anyone have questions? All right. So we know about GAAP, generally accepted accounting principles, and we know that those they were created and continue to be modified by the Financial Accounting Standards Board, FASB. So that's who determines what are the principles that financial accountants should follow. Okay? The FASB. If your company does a lot of international business, you might choose to not follow GAAP, but instead to follow the International Financial Reporting Standards, or IFRS. We do not really get into IFRS in this class. We are focused on GAAP because that's what most American companies use. probably at some point in the future, GAAP will go away and all American companies will use the international standards. But I don't know when that's going to happen. And for now, since GAAP is still dominant here in United States accounting, that's what we will focus on. And I don't know anything about IFRS anyways, so I wouldn't be much help to you even if we were going to try to learn it. But from what I understand, it's not that different. It's the same sort of thing. It's just a different system. Like Mac versus PC, right? They both work pretty much the same, but if you're familiar with one, you're saying no. There are some major differences, right? But they are both computers that act on the same fundamental principles. Okay, so publicly traded companies have to submit their financial statements. Their financial statements have to follow GAAP. And if they don't, they get in trouble with the SEC, which is the Securities and Exchange Commission. Okay, so FASB created GAAP, and the SEC enforces GAAP. Okay, the SEC is part of our federal government. It is an agency of the federal government of the United States. What does it mean for a company to be publicly traded? Yes, and their stock can be sold over a stock exchange. You can have a privately held corporation where you sell stock to individual private investors, but those investors basically have to be what are called accredited investors. So the average person cannot buy stock in a privately held corporation. But if you are a publicly traded corporation, then your stock can be sold over stock exchanges. That means that your investors can sell stock to each other. So an investor might buy stock from a company and then sell it over a stock exchange to somebody else. Okay, and those companies, those publicly traded corporations, are heavily regulated by the SEC because the SEC wants to make sure that these corporations are not lying about their financials and are not committing fraud. Okay, so that's why we have this system in place. So let's get into this conceptual framework, the different concepts and principles that make up GAAP. There is an accounting stuff video on this topic if you want to refer to that. But let's just go ahead and talk through them. So first we have the revenue recognition principle. What is meant by revenue? What is revenue? Gains? Okay. Yeah, I mean, we wouldn't use that word because a gain is when you sell an asset and you make money from it. But revenue is the income a company earns from selling its product or service. You might think of it as their sales in dollar amounts. So if a company earned $1 million in revenue, that means they brought in $1 million, and it's primarily going to be from selling their product or service. There are some other types of revenue, but mostly it comes from sales. Okay, so the revenue recognition principle says that you count the sale, you count the revenue when it occurs, not when your customer pays you. So if your customer makes a purchase this month and doesn't pay you till next month, it doesn't matter. You still counted it this month when you made the sale. That's when you count the revenue. Okay. Now, if you have a small company or a nonprofit organization and you use the cash basis accounting approach, then that would not apply, right? But most companies don't use the cash basis of accounting. Do you remember what basis most companies use? What it's called? Yes, who said that? Yes, good. Jeanette. Accrual, right? Accrual means that you count the revenue when it occurs, not when the customer pays. And since most companies do that, that's standard in GAAP, okay? Any questions on that? Okay. So then we have the expense recognition principle. Now you might remember that the income statement is primarily your revenues minus your expenses, right? So we have a principle related to revenues that we just discussed, and here's another principle related to expenses. What this says is that the cost of making your product can only be counted as an expense once you have sold the product. So you have to match that expense with the revenue from the sale. Okay. So let's go back to that situation where we made a sale today and customer hasn't paid us yet, but it doesn't matter because we're using accrual-based accounting. So we have to follow the revenue recognition principle. So the customer makes a sale today, we count it as a sale today, even though they haven't paid us. And because they have purchased our product, we can now count the cost of that product as an expense. We might have made the product last year. Maybe it's been sitting on the shelves all this time, but we couldn't count it as an expense until today when we sold it. Okay, and that is the expense recognition principle. You have to match the cost of your product with the revenue. Only count it as an expense when you've made a sale. All right, some of these are not going to be as hard to explain. Those first two are a little tricky. Any questions on those first two principles? Right. So the third one, the cost principle. This is pretty simple. It says when a company buys something, that amount that they paid is what's reflected in their accounting records. So if the company bought a building for $500,000, they would go into their accounting records and under their building account, they would put $500,000 as the amount of building that they just bought, okay? And then let's say the next year that building has gone up to $700,000 in market value, or maybe it went down to $300,000 in market value. It doesn't matter. It's still going to show the original cost on the company's accounting records. Okay. So that's all there is to the cost principle. Full disclosure principle says that you have to disclose everything. Maybe you've got some expenses you don't really want to report, but you have to. Under GAAP, anything that an investor should know about, you need to include in your financial statement. You can't withhold information. Okay? There are more of these principles. The separate entity concept is also pretty straightforward. It says that the owner or owners of the business and the business itself have to have separate financial records. So if you start your own business, even if it's a sole proprietorship, you really want to have a separate bank account for your business and not mix it up with your own personal finances. Because if you get audited by the IRS and they come in and they're looking through your bank statement and they say, oh, okay, I see a business expense and you had some money that came in from a customer and then you went to the Bahamas and had a vacation. Why is that in here with your business expenses? They will not be happy about that. You might even get fined. I don't know, but you want to keep those personal financial records separate from business records. Okay. Now you can, as I think we discussed last week, withdraw money out of your business and you can put money into your business, but you still want to make it clear that that's happening, right? So you would take money out of your personal bank account, put it into the business's bank account, or the other way around. So it's clear that it was either an investment or a withdrawal. Okay? Then we have the concept of conservatism. I wanted to add an extra syllable there that wasn't there. Conservatism. That basically says if there's any gray area when you're doing your accounting, you always go with the more conservative amount. So let's say, you're not sure if your sales from this month are $10,000 or $11,000. Well, first of all, you should be sure, you should know. But if you didn't know, you would go with the more conservative amount, the one that makes you look less profitable. Because if you go with the other amount and it turns out to be wrong, well, you could be accused of fraud, right? But if you went with the more conservative amount and you were wrong, then it's obvious you weren't trying to trick anybody, you just weren't doing a very good job of being accurate, okay? So you always go with the more conservative amount if there's a gray area. There aren't that many gray areas in financial accounting, but they do come up sometimes. Everything we do in financial accounting is financial. It's all measured in dollars and cents. Okay, so that is the monetary measurement concept. The going concern assumption says that it is assumed that any business is going to keep going indefinitely into the future. It's pretty rare that somebody starts an organization and plans for it to only last for a certain period of time. Okay. I can't even think of any organizations off the top of my head that are like that. So in general, when we start a business, it's expected that this business is just going to keep going on until it goes out of business or maybe gets acquired by another company, right? But otherwise, they just keep going. And the last one here, the time period assumption, just says that even though financial statements are often for a year of time, we can make financial statements for other periods of time, like a quarter, which would be 3 months, 1 month, or even shorter than that if you want to, okay? So financial statements could be for various periods of time. So I know it sounds like not the most exciting stuff to think about these assumptions, but they will be helpful to you as we go through the course, because once in a while something will come up and you'll see it relates back to one of these concepts or assumptions. Does anything need clarification? Okay. Well, let's keep going. We can see here the relationship between the SEC and FASB. Let's see, does anybody remember what SEC stands for? SEC? Yeah, there's an and in there, Securities and Exchange Commission, but that's right. What are securities? We haven't really talked about that. What does that word mean? Securities.
Isn't that just stocks?
Stocks and bonds could also be considered securities, right? So that's part of what this federal agency oversees. And exchange, the fact that these are traded over stock exchanges and that companies make claims about their profits through their financial statements, all of that is enforced and overseen by the SEC. And they don't mess around. I mean, they'll throw people in jail for fraud. They'll fine people. They take it very, very seriously. Except somehow they let Bernie Madoff off the hook when they investigated him. I'm not sure how that happened. But anyways, FASB, again, they're the ones that created and continue to modify GAAP as necessary. What did FASB stand for? Very good. That's right. And we know GAAP is generally accepted accounting principles, right? Okay. And GAAP includes all these different concepts and principles we were just talking about. All right, we are familiar already with the accounting equation. There is an accounting stuff video on that topic. One way that James explained this in the video that we saw was assets are things that you own, and then liabilities and equity are things that you owe. The liabilities you owe typically to another company, whereas the equity is what the company owes to the investors. So that's one way to look at equity. I tend to say it's the value of the company, but he described it as what the company owed to the investors. Okay, and that is the basic accounting equation. So here are some terms that we'll be using. Account. An account is basically a name and a number that are used to keep track of transactions related to that particular thing. Like there might be any company would have a cash account where they keep track of how much cash they have in the bank. So cash would be the name. They would assign a number in their accounting system for that account. And then any transactions related to cash, whether it's cash coming in or cash going out, would get recorded in that cash account. Okay. And companies could have dozens, in some cases, maybe hundreds or even thousands of accounts, depending on how big the company is. We will become familiar with the most common accounts. The general ledger, or I'll typically just say the ledger, is where those accounts live. It used to be a book, but now we do everything on computers. But it used to be that the accountants would have a book called the ledger, and there'd be a page for every account, maybe multiple pages. So you could flip to the cash page in that book, in the ledger, and then see all of the cash transactions. Okay. Let's see. I've already talked about that. When we record transactions, the first place we record them is actually the journal. And the journal is like back in the old days, before computers, before my time. The journal was also a book. And in this book, every transaction got written down in order, in the chronological order in which it happened. Okay. So whereas the ledger is divided by account, the journal is just one long list of all the transactions. And we're going to record every transaction in both places. You record it first to the journal, and then you copy that information over to the ledger. Okay? Let's say we have a situation where we made a sale to a customer, and they paid us cash. Well, we would record that we got cash, so our cash account has gone up. And we would also record that we made a sale. So our sales account has gone up. So in the journal entry, we would list both of those accounts. And then we copy whatever amount we put for the cash over to the cash account in the ledger. And whatever amount we put for the sale, which would be actually the same amount, we would copy that over to the sales account in the ledger. Okay. And at that point, we've done steps 2 and 3 of the accounting cycle. Step 1 was to analyze the transaction and know what happened. Step 2 is to record it to the journal. Step 3 is to copy that information to the ledger. Right. Any questions at this point? Everything makes perfect sense? Okay. Very good. Here's another accounting stuff video you might want to watch about debits and credits. In both the journal and the ledger, we have to use debits and credits, okay? And all it means is that when we record something, there's a left column called debit. There's a right column called credit. And these words come from Italian. Origin is kind of interesting, but I'm not going to spend time on that. Just remember, debits are on the left, credits are on the right. Okay. So if we go to our cash account in the ledger, and again, we had made a sale, so we got some cash. Well, that means cash has gone up. Did I talk about the DEAL acronym last week? I think I did, right? Okay. So we know that dividends, expenses, assets, and losses, when they go up, we record on the debit side. So we would record that extra cash we got in the left column, the debit column. If we paid money for any reason, well, then our cash is going down. And then we'd have to record it on the credit side. Okay. So that's how we basically keep track of things in this double entry accounting system. We have to add up the debits and subtract the credits to figure out what's the final balance. Or if it's an account that gets more credits, we would add up all the credits and we would subtract the debits. Okay. That's where it starts to get a little confusing, to be honest. And we're going to have we have 25 exercises this week. A lot of exercises to help us, get used to this concept of debits and credits and the accounting equation. Right. I'm sure somebody's got a question out there. Somebody asked me a question. Oh, you look like you have a question. Huh? Okay. All right. We'll keep going. So we know the accounting equation, right? And I told you we would be looking at an expanded accounting equation. That's what we see here. Assets equals liabilities plus equity, but then equity is made up of these other four types of accounts that all either increase equity or decrease equity. Okay. So this chart here, which is in the textbook, you can also download this PowerPoint if it's helpful to you. This will be useful when you get confused. If you've got a situation where you're trying to figure out, am I supposed to debit or am I supposed to credit? You could always use that DEAL acronym to help you figure it out. But if you get stuck or you're just not sure, you could take a look at this. So what did DEAL stand for? Who can tell me? What was that acronym? Exactly. Dividends, expenses, assets, and losses. Okay. So the E stands for expenses, not equity. And the L stands for losses, not liabilities. Okay. Because those are easy to mix up. Dividends, expenses, assets, and losses. And what is the significance of that acronym? What does it tell us? Yes, when those accounts increase, we record it on the debit side. So let's find them here. We can see dividends. When they increase, we debit. Expenses over here. When they increase, we debit. Assets, also when they increase, we debit. Now losses is not on this chart, but it would also show that we debit when a loss increases. Okay? Every other account that's here, if it increases, where do you record it? On the credit side, right? So you see liabilities, when they increase, it's on the credit side. Common stock, same thing. When they increase, credit, and revenues, when they increase, you credit. Okay? So that acronym, again, is going to be really useful when you have to figure out, do I debit or do I credit? Any questions on that? Now, one thing that does get a little confusing, but I want to go ahead and just call it out right now. Notice over here it says equity. It says minus dividends and minus expenses. Dividends and expenses both decrease equity. Right? Because a dividend is taking money out of the company, taking the profits and giving it to investors. So it reduces the value of the company, it reduces how much is owed to the investors because they already got it. The dividends reduce equity, expenses reduce equity, right? So if we have a dividend going up, equity is going down. So even though dividend is an equity type of account, the impact it has is it reduces equity. Same thing with expenses. When expenses go up, equity goes down. Okay? All right, let's move on. Now, sometimes in the exercise set and maybe in the problem set this week, it might ask you about normal balances. Well, you can use that same deal acronym. Dividends, for example, are part of deal. And that means when they go up, we record it on the debit side. And so they normally have a debit balance. Whatever side you would record on when something increases, that is the normal balance. Because things normally in accounting increase more than they decrease. Let's take cash as an example. Cash is what type of account? Asset, liability, or equity?
Assets.
It's an asset. It's something you can own, right? And because cash is an asset, we know it's part of deal, right? The assets are part of deal. So cash, when it goes up, we would record it on the debit side, and we would normally have a debit balance in our cash account. Let's say we got $1,000 of cash, we debit it, and then we paid $1,000, and we'd have to credit $1,000, and we'd be back down to zero, right? Are you ever going to have negative cash? Is that a thing? Can you pay out more cash than you actually have? Not really. You can borrow money and get more cash, but you can't really pay somebody cash that you don't have. So you're never going to have, except maybe some really weird extreme situation that would be a fluke, you're never really going to have a credit balance in the cash account. It's either going to be zero, or if you have any amount of cash, it's going to be a debit. Okay? So in other words, whatever column, debit or credit, you would increase on, that is the normal balance in that account. Right? So we see that here. Assets increase on the debit side, normally have a debit balance. Liabilities increase on the credit side, normally have a credit balance. Okay, so don't get thrown off by that phrase, normal balance. Just think back to the deal acronym. If it's part of the deal acronym, it normally has a debit balance. If it's not part of the deal acronym, what balance would it normally have? Credit. Exactly. Okay. All right. Stockholders' equity. is actually two things. I think I've mentioned this before. When an investor invests money into a company, that increases the equity. And when the company earns a profit, that also increases the equity. So the part from the investor we call contributed capital, because that is what the investor has contributed into the company. And retained earnings are the profits that the company has made and not spent. So it's the earnings of the company that it has retained. Okay, so just remember equity has two parts. We can see it here in that accounting equation. Assets equals liabilities plus equity. Equity consists of contributed capital reflected in common stock, or later we'll learn about preferred stock, and retained earnings, which comes from the revenues minus the expenses. And then also it's those retained earnings that are used to pay out dividends. Okay, so equity gets a little bit complex because of these two parts. Anything need clarification? Okay. All right, we're familiar with a lot of these accounts. What was an account receivable again?
Money you pay, money they owe you.
Okay, money your customers owe you, correct? We know that cash includes checks and any money in your bank account. It doesn't have to be, actual paper currency. Inventory includes any materials we're using to make products, but it also includes our products that are either in process or finished. Supplies, I think you know what supplies are. However, remember when I told you that we don't count the cost of a product as an expense until it's been sold, right? And something similar applies with supplies. Supplies are not considered an expense until we have used them. God bless you. So if I go out and I buy $100 worth of pencils, I don't have an expense. What do I have? I think I heard it. 100 pencils, but I heard something else over here. Asset. I have an asset. It's something I own. Once I use the pencils, they become expenses. And that kind of makes sense if you think about it, because let's say I buy the $100 worth of pencils, and then I decide I don't want pencils, and so I sell them to somebody else. They were never an expense, right? They were an asset, and then I traded them for another asset. There are some expenses that are prepaid. This would be something like insurance or rent, where you usually pay in advance before you use it, right? Like for rent, you usually are supposed to pay by the first of the month, right? For that month. You don't wait until after you've stayed there for a month and then pay for it. You pay for it ahead of time. And same thing with insurance. The insurance company calculates how much you'll owe usually for a year, and you can pay it all up front, or sometimes they'll let you make payments over time, but you have to start paying up front before you use it, right? When companies pay for insurance, they usually pay for an entire year. So what they would do is they would count that insurance policy as a prepaid expense. And then every month, they can take away part of that prepaid insurance. I misspoke. They count it as prepaid insurance. And then every month, they would turn that into an insurance expense. So that by the end of that year, the entire policy is now considered an expense. Okay. And same thing with rent. You would count it as prepaid rent until the month goes by, and then you would count it as a rent expense. So does anybody remember how a note receivable differs from an account receivable? Or what does the word note mean in accounting?
Loan.
A loan. Okay. So an account receivable means our customer owes us money for something they bought from us. A note receivable means somebody owes us money, so we're going to be receiving that money from them because we made a loan to them. And they're going to pay us back. Okay. And unless you're in the lending business, you wouldn't be doing that very often as a company, but it does happen sometimes. Actually, there are times when, let's say we have a customer that wanted to buy something from us, and we didn't trust that customer. We didn't want to give them an account receivable and let them pay next month because we don't think that they're going to pay us. So what we might do is instead have them sign a note. And that way it's really clear in writing that they owe us a certain amount of money. It's clear when they're supposed to pay us and how much interest we can charge them in the meantime. So I'll take it back. It's not always a loan. It could be a response to a purchase, but it is more formal than an account receivable because both parties have to sign this document that lays out all the terms of the agreement. Then equipment, obviously that could be either equipment we're using in our production facility or any equipment that the company has. We will learn later about depreciation of equipment. It's a way to take the expense of the equipment and spread it out over a long period of time. And the reason you would do that is basically because the IRS says you have to. With major purchases, you can't take all the expense at one time. You have to spread it out. Same thing applies to buildings, machinery. Land, however, does not depreciate. So like if you build a building, you can expect over time that building is going to need repairs. It's going to become, if you don't take care of it, it's going to become less valuable. But with land, that's not really the case. Land has been there for millions of years. And so for tax purposes, it's considered that it just holds its value. Now, the market value might actually change, but we don't depreciate land. And don't worry, we have a chapter on long-term assets where we'll get into detail on how to depreciate. So you don't need to know that just yet. All right, so these are some of the important terms and concepts we'll be using. All right, so any questions out there? Keep going, we see some examples. Obviously, we've got cash here, buildings, inventory, and equipment. Right, so just illustrate some of these different types of assets. Okay, here are some liability accounts. Accounts payable, what does that mean? Yep, it's money that we owe to somebody else, typically for a purchase we've made. Notes payable is also money we owe to somebody else, but again, a note tells us it's more formal. There's an interest rate and very specific terms of when we need to pay it back. All right, here's a new term. I don't think you've seen this, unearned revenue. Does anybody know what that is? We said that revenue is when you make a sale, right? It's what you earned by making a sale to your customers. So what do you think unearned revenue might be?
Paid for.
Yeah, exactly, it is. So if your customer has paid you for a product or service and they have not received it yet, then you have not earned the revenue, right? You need to provide them with that product or service because they paid you. So it's called unearned revenue, And it's actually a liability because we owe it to them. But that can be a little tricky because it's got the word revenue, and revenue is normally an equity account, but this is unearned revenue. So it's not equity, it's a liability. Okay? Anytime you see the word payable or you see unearned, you will know that that is a liability account. Payables and unearned are always liabilities. Okay. So again, the expanded accounting equation. We know that the income statement is made up of revenues minus expenses. You remember how it's important to make the financial statements in a certain order, where you have to make the income statement first? Remember that? So you can take the net income and use that as part of your statement of stockholders' equity. And then you take the equity from the statement of stockholders' equity, and it becomes part of the balance sheet, right? And we can see how they fit together here. Here's the accounting equation again: assets equals liabilities plus all these different equity accounts. We have the contributed capital, that is the stock from the investors based on whatever they contributed to the company. We have beginning retained earnings, that's how much profit the company had at the beginning of the period. We add to that our net income or net loss, and then subtract any dividends. So when we do this formula here, that is the formula for the statement of stockholders' equity. And then we can put that result, as well as assets and liabilities, on the balance sheet. Okay? And that gives us 3 of our 5 financial statements. Okay, let's keep going. Oh, good, an exercise. So let's do this. Pause the recording. Yes, I'll pause the recording and I'll have you work on it in groups. Okay, so I've mentioned the accounting cycle to you already. How many steps are there in the accounting cycle?
9.
There are 9 according to our textbook, plus an optional step that is the 10th step. But James, you might remember, he said there were 8 steps. So it kind of depends who you ask. But for our purposes in this class, we'll say 9 required steps in the accounting cycle. This week, we're focusing on the first 4. In fact, we've already been talking about them. First, you have to identify each transaction and analyze it to understand what happened in this transaction. Was it a sale? Was it a purchase? What was it? Once we have analyzed the transaction, we can record it to the journal. Remember, that was the first book I told you about, where everything is in chronological order. But then we copy every transaction over to the ledger. And what was different about the ledger? How are things organized in the ledger?
By account.
By account. Every account has its own section of the ledger. So you can keep track of the balance of every account. Then, once we're done with all of those transactions for the period of time that we're dealing with, let's say for the month, for example, then we could do a trial balance. And the trial balance is designed to help us see if we have any mistakes. What we do is we take the balance of every account. We'll look in the ledger and see, okay, this is how much we have in our cash account. This is how much we have in our sales account. We list them all on one report called the trial balance. And because some accounts will have a debit balance and some accounts will have a credit balance, we can add up those 2 columns of all the accounts and they should match. Okay, and if they don't, then we know that there's a mistake. So again, those are the first 4 steps of the accounting cycle. Next week, we're going to learn about adjusting entries and an adjusted trial balance. Then we'll learn about the, and also making financial statements. Then we'll learn about the closing process. At the end of the period, you have to close out your books so that you can start the next period with some of your accounts at 0. So like revenue, for example, every year you want to start from 0 so you can know how much you sold that year. So we'll close out the books and then make another trial balance, the post-closing trial balance. And then there's the 10th optional step. Now, you might have noticed there are 3 trial balances, right? Step 4 was a trial balance. Step 6 is an adjusted trial balance. And then step 9 was a post-closing trial balance. They're all basically the same. You just do it at 3 different steps in the process. Okay. So that is the accounting cycle. All right, any questions? All right. So the journal, that was step 2, right? After you identify and analyze your transactions, you record them into the journal. And like I said, we don't really use a book anymore. Most companies computerize their accounting. In fact, a lot of them automate it so that it just happens automatically. The transactions, like somebody goes through a cash register, makes a purchase, and the cash register just sends the information directly into the accounting system, and nobody has to think, is this a debit or credit, because it's automatic. But you still have to understand how it all works, right? Even if it's not going to be something you actually have to do on the job. So the journal, step 2, looks like this. It's pretty simple. Obviously, it says general journal. Later on, we'll learn about special journals, but the general one is called the general journal. And with every transaction, you record the date of the transaction. You record the accounts that were involved, and there will always be at least 2 accounts involved in every transaction. You record how much gets debited to the account that's getting the debit, and how much is getting credited to the account that's getting the credit. That's it. Well, you might also put a note explaining what the transaction was, but that's all. Now, our debits are always going to equal our credits. I think I mentioned earlier, you made a sale for, maybe I didn't. Let's say you make a sale for $1,000 and you got paid $1,000 by the customer. Well, you would debit cash, $1,000, and you would credit sales, which is not part of deal. So when a sale happens, you record that on the credit side. You would record the $1,000 sale on the credit side. So we have a $1,000 debit and a $1,000 credit. And it's always going to match. Your debits and credits will match for every transaction. And that's why when you do a trial balance, the debits and credits on the trial balance will also match. Okay. Oh, and by the way, there is an accounting stuff video on the general journal as well. So then step 3, who remembers what was step 3?
Post journal information to ledger.
Exactly. We post the journal information over to the ledger. So we copy whatever we put in the journal into the individual accounts in the ledger. So here we see 2 accounts, one getting a $200 debit and one getting a $200 credit. Okay. It's accounts receivable and it's cleaning revenue. So what do you think happened in this transaction that would cause us to record into these 2 accounts specifically? Why would accounts receivable go up and cleaning revenue also go up? Okay, we haven't gotten paid yet, which is why accounts receivable has gone up by $200. And what about cleaning revenue?
You provided cleaning service.
We provided a cleaning service, right? As soon as we provide the service, we can count it as revenue, even though we didn't get paid. So we have $200 of revenue, but we haven't been paid. We have a $200 account receivable, which is like an IOU from the customer, right? Here is a trial balance. So this would be step 4. If we took every account balance and put them here on the trial balance. So we see at this point, cash has a certain amount of money. I told you cash is always going to have a debit balance, right? Because you can't have negative cash. Now, we start off with the asset accounts, right? Cash, accounts receivable, office supplies, prepaid insurance, and equipment. All of those are different types of assets. In fact, we started off with the current assets, and then equipment is a long-term or non-current asset. And so all of those would have a debit balance. Next, we go on to the liability accounts. We know that payables and unearned are always liabilities, and they're not part of deals, so they would normally have a credit balance, right? Which they do. Then we get to our equity accounts. We start with common stock. That, it's not part of deal, right? Common stock is not part of deal. It's not a dividend, an expense, an asset, or a loss. So that means it increases on the credit side, and it normally has a credit balance. Then we have dividends. Dividends are equity types of accounts, but they are part of deal, right? So they increase on the debit side and normally have a debit balance. Revenue accounts, not part of deal, normally have a credit balance. Expenses, are they part of deal? Yes, right, they're the E in deal. And so they normally have a debit balance. So we would take those balances from all those accounts, put them here, add them up. Again, our debits will equal our credits. Right? Okay. Any questions at this point? Got 20 minutes before the break, so hang in there. I know it's a lot to take in. Okay. Another new term, original source. A lot of accounting transactions you know about because they happened just as part of the day-to-day business of the company. But sometimes a company will receive a document about something it didn't know about. Or it didn't know, God bless you, it didn't know exactly what the financial impact would be. For example, let's say the company receives a bill from the phone company or the electric company, and then you find out exactly what your phone expense or your electricity expense was. You knew the bill was coming, but you didn't know exactly what the amount was going to be, right? So in that case, you then have to take that information and put it into your accounting system and say, okay, this is how much we owe for electricity. So when that happens, we call it an original source document. So it's a time when something's written down and then that information gets passed to the accounting department, and then the accounting department has to put it into their accounting records, okay? So, all right, let's look through these 4 situations. This will test some of our understanding of these accounting principles we've been talking about. If our company bought a used van and we bought it for $11,000, but we think it's actually worth more than that, $12,500, which amount would we record in our accounting records? The original cost or what we think it's worth? The original cost. That is the cost concept, okay? We bought a building 5 years ago for 175,000. Today it's worth 250,000. Which amount is it going to show in our accounting records?
175,000.
The original cost. Okay. Then we've done a task for a customer who's agreed to pay us $2,350. They might give us a bonus, but we're not completely sure that we're going to get the bonus. How much revenue would we record? The original amount they promised, or would we include the bonus?
The original.
The original amount, right? Because conservatism, we have to go with a more conservative amount. Okay, and then this last one, the owner of the company wants to know if they can include the value of their employees on the balance sheet as an asset. Can you count the value of your employees as an asset? What do you think? Who says yes? How many people say yes, you can count the value of your employees as an asset? How many people say no? Okay, I think I saw 1 no and 0 yeses. And you're right, Ruben. So why can you not count your employees as an asset? Yeah, exactly. They work for you, but you don't own them, right? An asset is something that you own. Now, a lot of people in the business world will use the word asset in that way. They will say our employees are our greatest asset. But from an accounting perspective, that's not true. Because you don't own them. Okay. Now we have a bunch of examples. Lots and lots of examples. We're not going to get through all of them today, but let's take a look at some of these and hopefully it will help these concepts sink in. Okay, so here's a transaction that has occurred. The company issued $20,000 worth of common stock in exchange for cash that they got for an investor. So for the company, they got $20,000 of cash. That's an asset going up. And they issued stock, which stock is an equity account. So equity has gone up. Okay. Another transaction, the company bought equipment on account for $3,500. What does it mean on account? They haven't paid for it, right? So the company got the equipment and now they have a liability. They have an account payable because they haven't paid for the equipment. Okay. So you can see there's always, with every transaction, there are always at least 2 accounts being impacted. And whatever impact they have on the accounting equation, it always stays in balance. Right? If our assets equal liabilities plus equity, we can have a change on the asset side and another change on the other side of the equal side, and it's fine because they're either moving up together or they're moving down together. Or sometimes, and we saw this last week, you might have an asset going up and another asset going down. Or you might have a positive change to liabilities and also a negative change. Liabilities or equity, since they're both on the equal sign, they can offset each other as well. So any transaction, regardless of which accounts it's impacting, the accounting equation will still stay in balance. Okay, here the company got $4,000 cash in advance from a customer for services they have not provided. Remember that we call that unearned revenue, right? Which is a liability. So the company owes $4,000 of services, customer, and got $4,000 in cash. They're provided services to a customer, but the customer hasn't paid. So in this case, the company has the account receivable because they expect the customer to pay later. And they did provide the services, so now they can count that as revenue. Is our accounting equation still in balance? Yeah. We paid a utility bill with cash. Okay, obviously cash is going down. So that's an asset that's decreasing. And an expense is going up. The reason it has a minus sign here is because remember, when expenses go up, equity goes down, right? So our accounting equation is still in balance because equity went down along with assets. Okay. Any questions out there? Here's another one. Distributed $100 cash in dividends. So obviously cash went down by $100. What impact did dividends have on equity? Yeah, they reduce equity, right? So when dividends go up, equity goes down. Okay, these are all of those transactions listed out. So there was the stock that the company issued and all of the other transactions, right? If we take all of the different cash transactions, so we had 20,000 coming in, another 4,000 coming in, and then 300 and 100 going out. Okay. This is what you might do in the ledger. You would go to the cash account in the ledger, add up all the debits, subtract all the credits, see what is the final balance in our cash account. And we would do that with every other account. If we add up all of our assets, we get 32,600. If we add up all of the liability and the equity accounts, we get the same amount, right? Because that's what our balance sheet will show us. It will show us all the assets, and they have to equal the liabilities and the equity. So it's like a very complex puzzle that a monk came up with hundreds of years ago in Italy, but it works, and we still use this method today. Okay, we have these two transactions. Which of these two transactions will get recorded in the journal? Okay, the first transaction, this farm decided that they're going to raise their price on a gallon of milk. Would that get recorded into the journal? The fact that they've decided to raise their prices? No, because in the journal, we're recording every transaction, every sale, every purchase. If they make a marketing decision and change their prices, next time they make a sale, we are going to record that higher price, but they have to make the sale in order for us to record it in the journal. Okay. How about B? A customer buys a gallon of milk paying cash. Will that get recorded in the journal? Yes, it is a sale and the company got cash, right? So it's only when there's actually an exchange of some sort that there's a financial transaction, and that's what gets recorded in the journal. Oh, this is a quick and easy one. Let's go ahead. We'll do exercise 3. Okay, so a journal entry always is going to have a date. Remember, the journal is in chronological order, so the transactions occur in the order in which they happen in time. So we have the date. We have 2 accounts in this example. It's always going to be at least 2. And the first account you list is the one being debited. Okay, so for journal entries, you always start with the debits. So in this case, cash is being debited, $5,000. Common stock, notice that it's indented here. Any account that's getting credited, you indent the title of that account. And then you record in the credit column. Do our debits equal our credits in this transaction? Yep, and they always will. And then there's just a little note here that provides a description of the transaction. Sometimes there's really important information in the note that you couldn't really fit in here. And that's basically all there is to a journal entry. What do you think happened in this transaction? Somebody bought stock from the company, that's right. So the company got cash and the company issued or sold stock to that investor. Okay. Any questions? I think we have about 5 minutes left, so let's knock out a few more slides. Here's a situation where there are more than 2 accounts involved with this transaction. So here we see debits to cash and supplies and a credit to common stock. In both cases, right, both the debits and the credits equal $5,000. But what do you think happened in this transaction?
Cash and.
Yeah, yeah, so the investor got some stock. They gave the company some cash, but they also gave the company some supplies. So the company must have agreed to that and said, sure, go ahead and give us cash and some supplies and we will give you stock in exchange. Oh, here's a whole bunch of transactions. So I want you to memorize this. Okay, you got it? Okay, good. I'm just kidding. All right, so again, we probably won't get through all of these, but let's go ahead and look at a few of these examples here. So here's a company issuing $20,000 worth of common stock. Again, the company gets cash, gives out common stock. We can look down here and see what impact that has on the accounting equation. Assets went up from the cash, right? And equity went up because the stock was issued. Okay. Here's another journal entry. The company bought some equipment on account. The company got equipment, an asset, so it would get debited, right? And then the company has a liability because they haven't paid for the equipment. Liabilities increase on the credit side, right? So we see an asset going up and a liability going up. Company gets advance payment from a customer for services they have not yet done. We know that that is unearned revenue, which is a liability, right? The company got cash, they've got the liability here. You see assets and liabilities both going up. Here, the company did some work, but it hasn't been paid yet. So they have an account receivable. We know that is an asset, right? And revenue is not part of deal, so it increases on the credit side. So this is the account receivable, increasing assets, and the revenue increasing equity. Company pays a utility bill with cash. Okay. When you get that utility bill, that original source document, you know how much electricity you've used, and you can count it as an expense because you've already incurred that expense, even though you haven't paid for it. But now they are paying for it. So they've counted the expense, and cash is going down, right? Because they're paying it out. We have an asset going down and equity going down. Why is equity going down?
You get an expense.
Because we had an expense, right? So utility expense is part of deal, right? Expense is part of deal. So it increases on the debit side. So our expense is increasing, and that's decreasing equity, right? Distributed $100 in dividends. Just like expenses, dividends are part of deal and they reduce equity, right? So when we have a dividend going up, equity is going down. And then again, we have cash going out. So that's an asset going down. Got $2,800 for services rendered. In this case, it happened at the same time. We got paid at the time we did the services. So we get the cash and we can count the revenue. Okay. We are just about at break time. Are there any questions? All right, we'll stop there. I know it's a lot to take in, so enjoy your 10 minutes, come back refreshed, and we'll get working on the exercise set.
How'd you get your?
First try.
Yeah, first try.
I don't even know what my score was on the TV.